Welcome to the Give and Grow Show with Eric and Ryan. Ryan, how you doing today, man?
I'm doing good, man.
Another week, and we are blessed, man. Well, guys, we got an awesome show prepared for you today. Today, we're going to talk about real estate, and there's so much to get into. I mean, if you're a millennial, it is hard to get into a house right now.
Absolutely.
I was looking at statistics. I think more 30-year-olds than ever are living with their parents right now. And I'm not going to say they're living in their parents' basements, but where do you go? I mean, rent is so high. Mortgage rates are high. The prices of houses are at an all-time high. Right. So we're going to break it down today. We're going to talk about it. Neither of us actually own a house. We both rent. I rent a house. He rents an apartment. But we have done a lot of research. We've educated ourselves on a lot of these things. And we're going to just break down some statistics today and have a great conversation about it.
Yeah. I want to piggyback off that just for a little bit. A lot of people view the housing market as something that you should automatically be like, oh, well, I need to get a house to buy to live in. I need to not rent because there is this common thought that renting means you're throwing your money away. But with the current state of how things are, which, you know, we're about to go into the stats here in a little bit, it's probably harder now more than ever for a lot of people our age. I'm 31, he's 34.
That's right.
It was just a lot easier back in the day for people to just be like, oh yeah, I got to get into a house. And even for the area that we live in, we're in the state. I was reading a stat that we're in the state where we're in the top 5 most affordable places to buy a home compared to inflation in the entire states.
The whole nation.
Yeah, the whole nation. Even with that information, whenever we start talking about the plans that we have, it doesn't mean, oh, well, just because it's better than most, that it's the right move. Because like what we said before, we want to be in positions where with our vision of how we want our lives to be, we want to make the best decisions based off of that vision. So I just wanted to just like preface that.
Yes, sir. Yes, sir.
But some of the stats, I'm just going to just pull up my phone here because I was looking into a lot of these things before we came onto this right here. A lot of this data is basically data coming from a range of 1970 to now. So, you know, that's going to be the time period that we have right now.
I like that range.
Yeah, so, because, you know, the way that I see it is that 1970 was pretty much when inflation was at one of the highest it's been in like history.
Oh yeah.
Right before they started pumping the market full of money. And then you had the 1980s to arguably 2020, where rates were very low, inflation was very low, the market and the economy were all basically stimulated because, you know, the Fed bailed out everybody during like the 70s leading into the 80s. So
yeah, and we should also note in the 70s interest rates, that may have been the highest period of interest rates ever in America.
It was almost like 20%. I want to say it was within a range of like 15 to 20. We would be at depression level economy if we had 20% interest rates right now, and there would be not a lot of companies that can probably survive that.
Well, I would definitely be in T-bills if that happened.
Oh my gosh. Yeah. Why invest in stocks at that point, man? Come on.
Yeah.
But
T-bill and chill.
Right. T-bill and chill. But going into some of the stats that I have pulled up here, this is from anytimeestimate.com. The stat right here says that home prices have increased by 1,608% since 1970.
Okay.
While inflation has increased by 644%. Basically, what that says is, yes, the housing market has been increasing by almost double of what inflation has since 1970. So if one were to have bought a house back in 1970, the rate of inflation would not have killed them if their house was like, you know, the value of their home would have been able to outpace inflation and they would have gone, it would have gone ahead. But this is the biggest thing. Wages from 1970 to now have only increased by 50%. So if you were to average that over the past 50 years, basically wages only increased by like 2 to like 2.5% if you were to kind of like average them all out. Compared to,
you're saying per year?
Yeah. Per year, two to like, it's like 2.5%.
Okay.
Averaged up. Your wages aren't really going up.
Yeah.
And because if the rate of wages were to have increased with all of these, then all of us would be making a lot more money. But as you and I know, if they increase wages too much, that's just going to cause hyperinflation all over again. So that's just one stat with that. So wages haven't been keeping up with inflation, even though it hasn't been keeping up with inflation. The the stats show that your money going into a house would have just been really, really good.
So basically, you're telling me during that time period, real estate was a move.
Real estate was oh yeah, for sure. Real estate was the move going into where it's been now. It's up over 1,600%.
Awesome.
Since 1970. But the biggest stat that I wanted to bring up with these is that the value of the dollar has decreased by over 90% since 1970.
Really?
Around 80 to like 90%.
I did not know that.
Since 1970. Back in the day, since your dollar was worth a lot more, obviously the prices of like homes and like goods and stuff like that were a lot lower. But since the prices of homes have increased, with the real estate market going up, plus inflation going up, and the dollar's value has gone drastically down, wages haven't increased that much.
Mm-hmm.
That means that not only are you making less money, the amount of dollars you're actually making hasn't gone up a whole lot since the 1970s, which means to me that the markets and like this goes for like almost everything else, like it goes for like the stock market, the real estate market, like all these things are so overpriced in general,
right?
That like how can anyone, even your dollar's value is not really capturing a whole lot because you're not having enough dollars to keep up with all that. So like there's a big divergence between those two.
Yeah, I was just gonna say. Right.
The divergence is very, very high. But speaking to the housing market, it makes sense why nobody can afford to buy.
Before this, I was kind of researching, doing a 15-year loan versus a 30-year loan. But I do have some interesting takes just to bring to the conversation. One of them that I was listening to YouTube podcasts, just kind of educating myself. Something that I found interesting was one take, not to view the house as this growing asset, but it's actually an expense.
Yeah.
Because it's not actually the house that increases in value, it's the land that it's on.
Right.
Because this is real estate, but it's the land over time that increases in value. Like if you didn't get stuff remodeled in your house, it's probably not going to be worth a crazy amount compared to the increase that you're seeing in the land itself.
Right.
So to actually get that return, you actually have to put a lot of money into the house.
Yeah.
So remember with real estate, they act like, oh, go get you a house. You're building your assets. You're paying it off, but it's really the land, and a house is an expense.
Yeah,
so that's just kind of the way that I think about it. I mean, what do you think about that?
That is like a foreshadowing because that's something that I was going to talk about later on. But
sorry,
it's good. No. It's good to bring it up now because you're exactly right. I think that going back to our thoughts on like how the American dream is pretty much dead right now. Something that the culture is telling people is that a lot of your money is going to be in your home, and it's an asset that's going to keep on going up. But like what he was saying, it is really the land, and the more extravagant the house, that does increase the value of the home. But how much are you putting into it? How much remodeling are you doing? How much expenses are you putting into the repairs? Is it even on good land? All of these things take a really, really big toll that a lot of people, I think, don't really think about.
Yeah, and it even expands out. What's the area like? Are the public schools good?
Yeah.
All these things matter.
Huge. That's definitely something that influences my decision with housing, because just like what we tell y'all all the time, you should change your view on things by doing your own research and not just listening to like what people say. Now, I think that for the majority of people, having your own home and having a paid off home is a really, really good thing. But what's the baseline for doing that? Like, are you looking to build a lot of wealth, or are you looking to have a very, very safe and like comfy living? Because I would argue that you can have both. It might not be as optimal for the wealth building aspect, but definitely optimal, because houses are like a hedge if you think about it. Like absolutely. When it's paid off, the fact that you don't gotta pay rent anymore, and really you're just maintaining it. You can just pay for whatever expenses you have in there. When like hard times come, you have a place to live, and I think that a lot of people, especially now, want that so bad. But I'm not saying real estate isn't like a bubble, but it's a lot more unattainable than what it was back in the day.
Yeah, and I think we were talking about earlier, if you invested in real estate in the 70s and you're still alive, here in 2024, you're probably living pretty large. You've probably got good cash flow. I mean, you said the percentages. I mean, your assets have definitely increased. You're probably probably a very wealthy individual.
Oh yeah, you got hopefully. Because
if you did it right. Obviously, the people back then that had positioned themselves to be able to afford real estate were able to take advantage of that, and that's what we talk about every episode. You got to put yourself in position, no matter what cycle you're in the economy or the market or the real estate market. But my big thing is, how do we handle the situation we're in now? Because I think we both agree that all the money that gets pumped into the economy inflates everything.
Right.
But obviously our wages are not keeping up with that.
Right, they're not.
But the market, these great companies, really it's the Magnificent Seven are basically carrying us, but their stock prices continue to swell up.
Yeah.
Real estate continues to swell up. The amount of money that we're making working our jobs, it's not really increasing at a great rate. So, and the government keeps pumping money into the economy. So what is the answer?
The only wrong answer, like what we said in like a previous one, is to not think about these things. Because I think with like real estate in particular, when you do your research and you figure out how getting into real estate fits your plan and you work according to that, then it's whatever fits you. For us, we can start out with like talking about like kind of like how we feel about it.
Yeah.
And then go into like kind of at like a broad idea of like how we're going to approach this. So for me, knowing that houses are so expensive, interest rates are very, very high.
Yes.
It's costing a lot more to go into a home and feel that I'm not going to become house poor. With those things being said, I would say that for me, it's better to rent and stack cash and wait for the right opportunity. And this is very, very counter-cultural.
I mean, most things we do are, so that's okay.
Yeah. Well, that's the thing is that you have a lot of people coming out and being like, oh, well, look at y'all's income. Y'all can afford to buy a house.
Right.
Why aren't you doing it? I'll even quote Dave Ramsey. If you're not getting into it now, you're going to get left behind. Housing market only does this, and stocks only do this. And yes, over like a long period of time, you can say that for sure. The thing is, though, is that right now in this particular market, it's just out of the realm. And going back to Ramsey's plan, 20% down on the home, a 15-year mortgage, your monthly mortgage payment at most is 25% of your take-home pay.
Okay.
So if you were to run those numbers in today's market,
good luck.
Yeah, right. That's the thing is that you're based off. Based on the median household income. I forgot to bring this up in the stats.
Let's hear it.
The median household income as of 2024 is around $80,000 to like $85,000 a year.
Okay.
So the income that's the median does not support this at all. The amount of house that you can actually buy with those numbers is around like 185,000.
Yikes.
Max like 200,000. But look at the housing prices right now, we're talking at a minimum in like a decent area, 275. And obviously y'all know the max, like we're seeing houses like 400, 500, 600,000 that were maybe about 5 or 6 years ago around like 250.
And like you said earlier, this is in a city where the cost of living is considered very low.
The numbers that I was giving was based off of how much of houses that you can afford based off of that plan with like what they are, the median right now. The median used house price that was sold as of right now is around like 390,000.
Wow.
Over here specifically where we live, you're looking at around like, I'd say a minimum around like 300 in like in okay area, but the better areas you get, you're looking easily around 375, 450, sometimes even like 500,000 for the homes. The standard plan that Ramsey provides, you're probably buying a shack in like the worst part of the neighborhood. And I don't know about y'all, but that's not what I want. And you know, I don't even have children. So right. Like, I'm not even considering schools. The houses in the areas that have the best safety from what I've seen are going easily 375, 450 for like an okay home. The better homes, you're getting like 475, 500 for a lot of space and in like the better parts of the city.
Right. One can hope for a recession that kind of corrects all these prices in the real estate market. You don't typically rise to your hope.
Yeah.
You rise to reality.
One of the biggest things is I'm fine with renting right now if the rent is pretty much less than the amount of interest I would be paying when I have a home.
Right.
Because the thing is that when you buy a home, you're locked into whatever mortgage you have, and like, if you can't pay it, then you're kind of screwed. So what does that include? That includes principal, that includes interest, that includes HOA fees, that includes if you don't have a 20% down, that includes PMI, private mortgage insurance. So there's a lot of things that are lumped into your monthly mortgage that a lot of it you're paying more in that than you would just renting. Depending on the loan you get, a lot of that money that you're paying into it is not going to principal.
You're right.
It's not going to principal. It's going to things like it's going to the banks. And I mentioned this before that, y'all can call me crazy, but I want to give as little as I can to the banks, especially with these rates. I would rather have the interest that I'll be paying to the banks to actually be working for me in the terms of like what, like he mentioned earlier, T-bills, and like money market funds. And I can do that more efficiently right now renting.
Yeah. So you're saying basically with the extra cash you have on hand, you're basically going to put that in a money market fund, right, which is basically short-term T-bills, and you're just going to take the interest rate that they're offering on that debt, and you're going to make that as interest.
Right. I'll make that as interest. Now, we're saving up for a down payment still. I can't see a reason for me to get into the housing market, considering the entire landscape of the economy. Inflation data has been ticking back up.
Yes.
The housing market has actually been going back up. So now, so home prices since last year have come down. Mortgage rates have been coming down. I believe that the mortgage rates right now, we're sitting around like a little under 6%.
Okay.
And there's going to be a period where I think that, now, I'm not waiting for pre-COVID rates anymore. That's if I'm going to give you my honest opinion, I don't think we're ever going back to like zero to like 1% rates like that.
Yeah, I think those days are long gone for a little bit.
Yeah, I don't know how long it would take. It's possible that it could get there, but there's so many issues.
There's a lot of stuff that needs to be corrected.
Right. There's a lot of stuff that needs to be corrected. So when it comes to like the floor of rates that I think that we can get to, and I don't know if y'all have seen this number or if it's just me and him that have been kind of seeing this. Well, also too, the Fed kind of brings some of these numbers up too, but 3 to like 3.5% seems like a floor level now compared to like what it was before, which was like one to like 2% on on like interest rates. So that will affect the floor on like mortgage rates, which I think that 4% would be like a pretty decent one to get compared to what it was around like 2 back in like, 2021, 2020. I just feel that my money can work better outside of the home. And like, I might be wrong, but overall, all the money that we're putting aside for the house is going to grow. And instead of going into a home on like a 15 or like 30 year, I'm choosing to have the flexibility to have more liquid assets with like cash and letting that money grow there instead of being locked in. Because if I were to get a mortgage right now, whether it be 15 or 30, the amount of interest that I would be paying at least for the next 5 years is way more than my rent right now. It's way more, and that's not even counting money into repairs. Yeah, that like basically, I would like to take the amount of money that would go into interest, HOA, any kind of like costs, reoccurring costs, and instead of putting that into just having the home, I can I can take that and just invest that instead, basically.
Right. And when you say invest, you're in these money market funds.
Right.
There's no downside risk to that, basically.
Right. There's no downside
You're
risk.
just collecting interest.
Right.
So I don't want you to think that he just has it in the market right now.
Oh, yeah. Right.
What would happen if the market goes down 10%? There goes a good amount of your money. But it's protected. That's the beauty of the short-term treasury bills.
Right.
There's no downside risk.
Right.
You're just collecting that interest.
And that's just my plan. Like, I think that it's way different for somebody that has a different situation. Mm-hmm. So for example, theoretically, let's say that you were a parent with like 3 kids and, y'all made decent income. You need the space. Rents for like bigger homes are like very expensive. So it's like, I get like, okay, well, if I'm paying $3,000 in rent versus $3,000 in like a mortgage, that's different. I'm saying people's situations might be different because you might have a bigger family, your income might be higher, just things like that. Because I think that like buying a home right now, it depends on your situation. I'm not saying buying a home right now is not the way to go.
Right. I'm just saying if an individual thinks that rent is too high, yes, the mortgage could potentially be cheaper for a bigger house, possibly, but there's a lot of other extra things you have to consider, is what I'm saying.
Right.
Like, if you may not have an emergency fund. Like, I mean, your kid's tossing a ball, you break a window. That's you got to get that repaired.
Right. But like, you're probably if your mortgage
versus being
was like $3,000 versus rent being $3,000. Because for me, like I was saying, if renting is cheaper, then yes. But if it's about the same, then why not just buy the house?
Okay.
That's what, but most homes for like families are more expensive with rent. Honestly, like if you just wanted the home and you were okay with like how much interest you'd be paying and you can actually afford it, and if it was around the same as like renting, then buying a house it's not really like a big thing. You might want to consider how much house you're buying.
But see, I don't even see how you'd be able to afford the down payment if you can't even really afford the rent. Well, it's a side conversation.
Well, I mean, that's my thing is that all this stuff takes planning, right? Like if somebody was like, okay, well, if I don't have a down payment, then yeah, you shouldn't buy a home.
Yeah, that's
you
what
should
I'm
plan. Right. You obviously want to have plans, but like
this is all theoretical. So
right. It's theoretical, but like
we argue about these things all the time.
I mean, what I was saying was when you're ready to buy,
right?
That's when you want to consider rent versus buying.
Yeah, absolutely.
Like if you're not ready to buy, then
100%.
rent.
I 100% agree with that.
Right. So you want to have everything in place before you even think about it. Definitely do that. Like I got people telling me, there's why don't you do the FHA loan? I had someone tell me that there's stuff where you can put 0% down.
Ooh.
And I don't I know that they have best intentions in mind, but I'm not trying to have like a $5,000 payment a month. because for one, I don't make that much, but two, it just doesn't make any sense to me.
With those things, the banks are taking advantage of you, and I think that's when it comes back to understanding these things and positioning yourself. You have to understand that, like, the banks are not trying to help you. Like, you're never going to be able to position yourself well taking on things that you think are a good deal from the bank. They are their own system. They're trying to make money for themselves. It's just like credit cards.
Yeah.
Like, are there people that can take advantage of banks and take advantage of credit cards and make these things work in their favor from like a cash flow perspective? Absolutely. But for majority of individuals, banks and credit cards are going to take advantage of you. So understand that.
That's exactly what it is. They don't care about you. They don't. They might say that they do, but they're just trying to get your money. I'm not anti-bank. You should use them for your purposes. You want to find the best deal that the bank can give you. Mm-hmm. The problem is that just because they have a deal that's like better than like others doesn't mean that the time is the right time to actually do it. Which is why, like, you know, we want everybody to be more involved in trying to understand how money works, understand the cycles of the economy when it comes to like interest rates, when it comes to the markets, when it comes to inflation, because your money is going to work better for you when you understand these things a lot more.
Let me ask you this, because we can look back in 5 years at this video and kind of laugh at this.
Yeah.
But I mean, if you watch Dave Ramsey, he consistently says, you know, if you're in a position to buy a house, just do it, because the real estate market is going to continue to go up. But if you bought, and we'll see what happens, if you bought a house tomorrow, do you think in the next 2 to 3 years that you're going to look back and say, well, I'm glad I did that? Now, I know, and look, we can't look into a crystal ball and see the future. Is this time different? Because I 100% agree. Looking back the last 30, 40 years, yes, he is completely right. And you know, what do we know? You know, I mean, we're two 30-year-old millennials, but like, is this time different when it comes to buying? Are you literally buying at the top right now? What do you think?
Well, when it comes to real estate, it operates at like a safer level than some like stocks do, because I don't want to take my view of like the stock/equity market and apply it to the housing market, because they're both two separate things. There's definitely a possibility that there's a better time.
And every market is ultimately supply and demand at the end of the day.
Right. It's supply and demand, but there's always going to be demand for houses.
Exactly.
There's like, everybody wants to get into a house, so that the market might dip. You can even consider that, and you know, I'm saying the real estate market, it could dip/crash, but it's not as volatile as something like the stock market and stuff like that. If I were to buy right now and 2 years later look back, let's say it dropped like 10%, I wouldn't feel bad.
Right. Because in 30 years, you're going to be laughing at this moment.
Right. Exactly. Now,
and let's even throw in, let's say you bought a house in 2006 before the great financial crisis.
Right.
Obviously, you ended up underwater for a couple years. But the beauty of it, if you were positioned, I mean, when you got out of that leading up to now, you're looking back and you're laughing. And it all goes back to positioning.
Right.
I'm going to be so annoying with positioning. I'm sorry, guys.
No, that's all right. That's what it is.
But that's
I would say that this time, the thing that to me is kind of different, you have a bunch of like boomer/Gen X people. They've had their house for a long time.
Yes.
They have locked themselves into really good interest rates. And that goes for like a lot of people that bought during like, you know, right after the great financial crisis, and during like 2020, 2021, when you can be able to get a house on the cheap plus a really good interest rate. I think that right now we're in this like gridlock where the supply, there's not a lot of supply. So we have inventory issues, and nobody wants to sell their home because, you know, we talked about this yesterday. Why would I want to sell my home? I have equity on the home, plus like a 2.5% interest to buy another home and then get like a 6 to 7% interest rate. Like, it doesn't make any sense. So,
and the house price is insane.
There's not a lot to really get, because home prices will continue to go up because nobody wants to sell. There's not enough sellers.
You're right.
there's not enough sellers. And I think from like a generational thing, that you have a lot of people in their 50s, 60s, 70s, and above who are staying in their homes, not wanting to sell them. And unless they start pumping out a lot more homes, supply is going to continue to dry up. Demand's going to keep on going up. Everybody that have their homes paid off, they're doing good. But people like us, we can't even get a home.
I mean, when you say that, and I think about it that way, it just kind of makes me think. I mean, Dave is probably right. It might be a good idea just to buy a house now. It might be a good idea
if you're positioned. Right. If you're positioned, and if you know, because
what's going to change that? If you lower interest rates, I mean, yeah, demand's going to increase, but that's just going to make the prices go up.
What's going to change that is an increase in supply, and that can come in a multitude of different ways. But I would say one of the biggest ones over like the next 20 or 30 years is the boomers and Gen X passing away and their homes get onto the market.
Yeah.
You know, that's going to flood the market to me. Another thing is just building more stuff. But the thing is though, is that with rates being so high
and inflation high.
Right. With interest rates and inflation being high, it's going to be hard to have companies being able to have the workforce, because, you know, we haven't even talked about how that affects unemployment. It's gonna be harder for them to build homes at a pace that can keep up with the demand. So demand will keep going up, but if there's not enough houses being built, prices will still stay high.
I don't see all this, you know, this increase in homes being built, because when I think about that, I think of a thriving economy and a good cycle, everything's going up. I just don't see that period happening for a while.
Well, right. Well, we're not trying to be doom and gloom.
No. I'm not trying to be doom and gloom at all, but it's just what I see in the economy.
I mean, it's what you see, but those are the things that would need to happen. Supply needs to be a lot more. Inventory needs to be a lot more. You can see dips because, you know, we had a dip in the housing market, like what I said before, back last year from like June up until now. It's only begun to go back up.
Right.
It's only begun to go back. That doesn't mean you should get into it automatically, because, you know,
as long as they continue to pump money into this economy, we're never going to fix these issues, man.
We're never going to fix the issues. The biggest problem is that people can't afford it. Like what I said before, the rate in which homes are going up, you know, that's going up, but our wages and the dollar is continuing to stay flat or go down, and we can't afford it. I can bite the bullet and throw everything that I have in there, but renting to me is just a lot cheaper right now. It's just a lot cheaper, and you know, I could be shooting myself in the foot for that. There's other factors too, though, and this is not even economic, but it's more of like my life. I don't have kids. You know, I don't really have a real reason to buy right now, because like, you know, my savings / investing rate, I think, could be a lot better than having it in a home and being locked in. So I'm wanting to stay a little bit more liquid, a little bit more flexible, because I'm choosing the options route that I have right now.
Well, let me ask you this: do you value your assets growing more, or do you value owning a home more?
It depends on the state of which my life is right now. I think right now having assets grow more could be good, because, you know, I want to be able to grow more into like the cash flow aspect. Going back to what you were saying earlier, that's something that I was gonna mention, how viewing your house as an expense and not as an asset is important, because if I viewed it like that, then like having a house is more of an expense, and how much of that expense am I willing to actually put in versus just having my assets grow by me putting money that I would put into a home into my assets. I'm kind of in that camp right now. I don't want to get locked into a home when I know that I can rent for the cheap.
Do you value your investment positions more, or would you value owning a home more?
If it was paid off, I would value the home probably a little bit more. But see, I would value the home more with the money going into it if it justified me not giving the bank too much money. I think from like a peace mindset, and like just like a normal like what I want in life mindset, having a house is like one of the things that I want a lot more than most things.
Okay.
But like having assets that grow and create cash flow, I think overall they're both probably equal, I would say, because if I cared about assets slash cash flow, I would probably never buy a house, because mathematically, depending on like how much knowledge I can accrue and like being able to manage that stuff more, I could probably make a higher return than the housing market. But
or if your assets got so high over 10, 20, 30 years, I mean, you could just buy a house for cash and it could be a small amount.
Right. But
that doesn't do anything for you today. I know.
Right. It doesn't do anything for you today. And the reason why I'm not thinking like that is because, like what we've been saying, I can't predict the future. Things can change a lot. If I were to think over the next 30 years, like I'm not considering health issues, I'm not considering getting laid off, I'm not considering those things. So having a paid off home sounds a lot more enticing than potentially banking on having more money. But I'm not in one camp versus the other.
I got you.
I want to do it both at the same time. I want my assets to grow like crazy while I can work to have a paid off home, because
beautiful. I love it.
Because having a paid off home and having that with cash flow, like you can't get any better than that to me.
Yes, sir. Yes, sir.
So for me to buy a house, I need a correction in order to buy a house. That's the only way I can see myself buying a house. The amount of house that I would like to buy is the range of 300 to 400,000. And I know that's a big range. There's criteria that I would need to have with either a correction,
okay, or
if the housing market kept going up. I have different criteria for whatever path right now.
That's very wise.
The only thing that would make me buy a home within the next few years is if we have an actual correction in the housing market. Otherwise, I'm going with the plan, which I'll mention in the video. I'm going with that plan, and you'll see how much down I'm trying to get. You'll see the rates and all that whenever we get to that. But to your question, unless there is a correction, I'm going with the plan that I'm going with.
Okay.
If the markets continue to go up.
Yeah. So for us, I'd say in the next 3 to 5 years, I'm looking to put anywhere from 3 to 5% down, and I'm looking to do a 30-year, and our price range is about the same, between 300 to 400K. Now we could debate all day, because there's two things that I think you're going to disagree with.
Sure.
I think you like 20% down, and I think you like the 15-year over the 30-year, if I'm not.
It depends on like how much down. The 15-year, yeah, you're paying less in like interest, but you're paying a lot more monthly, and I think that can be a lock unless your income is like really high. Because here's the thing: if my income was through the roof, I could see myself getting like a shorter plan, but I might be leaving money on the table,
and the interest rate is going to be very important too.
Right. Well, see, that's
what we can't. And that's what we can't.
Well, I mean, that's my thing, is that like 3 to 5% down, if interest rates were so low, like sure, why not?
And adjustable.
Right.
Well, I'm saying right now, if they're still high, obviously you'd want to do an adjustable versus a fixed.
I would throw 3 to like 5% down if interest rates were the same back in like 2021. Sure, that's because because you're probably going to get. Yeah. Part of me doesn't even think that they're going to get to 4%. I think they're going to get to like 4.5 to like 6, maybe even like higher. So I don't see how having those interest rates would justify a low down. To me, you're just asking to be house poor. It depends. It depends on your like income. Now, his income is a lot higher than mine, so he might be okay with like throwing money away. But like, for me, I just think that I would be burning so much in like interest, which is why renting just makes sense to me a lot more right now. But I want you to justify that for me. Like, why 3 to 5%?
Well,
because you're also not counting private mortgage insurance.
Well, I mean, the mortgage isn't going to be that different from what I'm paying right now on my rent. That's with us only having one income. I'm assuming a couple of things, but hopefully at that point my wife will have a job. I don't know if we're gonna have kids yet, but I think I'd rather have more cash on the side versus throwing all that into the down payment. And I think my investments are going to outweigh the interest over 30 years on me paying off that home. So basically, I think I value my investments more than I do the home. But I see what you're going to say. I'm assuming there's three things I'm assuming. I'm assuming that the market's always going to have a continual return of 8 to 10%.
Yeah.
I'm assuming I'm not going to get sick, lose a job, or my wife may not get a job again. You know, that's an assumption. And then, lastly, I'm also banking that I'm not going to have any other crazy expenses where I might, need excess money to go. Yeah, right now, that's just the way I view it. I mean, a lot of things can change. If we have a kid, we're going to be considering that area. But I personally think that my money works harder in the assets. I don't view, we talked about this. Yes, the home is absolutely an asset. What you've paid off, the equity you have into it for sure. But I still view it as an expense. I mean, it can't cash flow me money in any way. When I sell it, I can make a gain depending on how much it's increased in value over time and based off how much I've paid off. But I value the cash flow that I can create from my investments more than I do the home over the whole 30 years. This is over the whole 30 years.
So let me ask you then
yes,
why,
sir.
why buy a house at all? Because you can rent for cheaper, arguably. If our thesis is that interest rates and mortgage rates are not going to be at a level that is justifiable, then why buy it? Because what's your rent? Your rent's like
it's close to $1,800.
Right. So I mean, I was running the numbers on 300 to like 350, even at like a 4% with like a 20% down, and the mortgage rate, or sorry, the mortgage itself was like 2,600. So if you were to take three, and that was with 20, that was with a pretty decent interest rate of like 4%.
Oh yeah.
With a 20% down. So if you're trying to get 3 to like 5%, you're looking at like a $3,000 mortgage.
Mortgage, yeah. No, right. I need a correction too, just like you, to justify me.
Okay. So that makes sense. It makes a lot more sense if the current climate changes.
Right.
I think because if you're getting like a $300,000 home and interest rates are like really low, and the mortgage rates are low, I can definitely see it. So plus with like you potentially having like a dual income. But the thing is though,
right,
rent prices would also go down if that's
what I was about to say. But just like over a 30-year period, I value my investments over my home. It would be the same thing. I value paying off a home is more beneficial to me versus 30 years of just paying rent to somebody else. Because at least I'm still in a way paying that money to myself over the 30 years versus the 30 years we're just running that whole time. That money is just going to somebody else.
But the money that you would put into the mortgage in the early years. Okay. So think about like the first like 15 years. You'd be paying double the amount in 15 years in interest to the bank versus the rent.
But that goes back to my investments. I think that's going to outweigh all that.
Right, but you would have more just renting. You'd have more money to put into investing instead of putting it into the home.
No, I mean, you're right, but I'm not. But over 30 years, I'm not. I'm just giving that money to somebody else. Versus 30 years, I'd rather just.
Yeah, but like you're giving your money to the bank with the house either way.
Yeah, but over 30 years, when that 30 years is up, I'm going to own that house. That house is going to go on to that's going to be an asset for me. So now, let's just say it's a 300. Let's say at that point, the price has increased to 450,000. I'm going to own that house outright at the end of that 30 years.
Right. So
and my investments are going to be way more than that.
So you're considering the long term.
Absolutely.
Like you're not considering how much money you can make as quick as you can. You're considering the amount of money that you'll make over 30 years.
Absolutely.
Which I also think is just assuming a lot.
Yeah.
So that's the thing is that I think that if you're okay with that,
yeah, I am.
I'd say that the risk is that you're assuming too much.
But when you say I'm assuming, as far as like the return on the stock market,
right?
Do you have an issue with me assuming that it's going to be a 7% return over the next 30 years?
Well, I mean, depending on like when you buy your home, and depending on like what's going on right now, I mean, you could say that like if the market does crash and you get in, like you can be able to make good percentages that can like last a certain amount. But it's an assumption to think that you can maintain a I would argue even like a $4,000 mortgage payment during times like these.
I don't want to do that. I'm not going to do that.
But like that's what I'm saying though, is that like renting is much cheaper than buying right now. So you're saying when the times are actually good is when you would start this process.
Right. And I can't assume that the times are ever going to be right, but I'm hoping eventually I'm going to be positioned enough where it's not really going to matter.
Okay, so that's different then. I think that if you had a ton of money,
right, and
you're like, okay, well, I know that my assets are going to be able to make a certain amount that's going to outweigh the amount of interest I'm paying. Mm-hmm. I think that makes sense. I think that if you're starting from a place where you don't have assets,
right,
or very little assets,
I'm not doing that plan.
I mean, shoot, I would even say not even like $100,000 in assets. Like, I think personally, you need a lot more than that to like justify that.
Oh yeah.
So that makes a lot of sense. Okay, that's good to like it's like clear up, because if you had like $400,000 in assets, getting like a 3 to like
probably not sweating it that much. Yeah,
exactly. But if you were someone that was like right out of college, or someone that, you had like $100,000 income, but your assets weren't that much, mm-hmm. I would say you're throwing money away if you were to go into a home at like 3 to like 5%
down payment. Yeah.
Right. Now, the difference is you could technically, if you really wanted a house at that time, I think you should go, traditional 20%. And not 15, but like 30.
But see, how's a 20-year-old or a 25-year-old going to have a 20% down payment?
That's what I'm saying.
Right.
That's what I'm saying. So really, the answer is don't buy until you're absolutely ready. Because here's the thing, he's obviously more on like the math route, obviously the more risky route. I'm more on like my life,
the psychology.
So yeah, the psychology, but. Well, see, I would say that I'm more in like the middle, because, math is important, which is why, my plan for like buying needs to be so good that it justifies it mathematically for me within like a short amount of time, because he's okay with like having a long term, because he's like, okay, well, I'm paying a lot of money right now, but if it does work based off the math, then yeah, assets will be able to outweigh. I
mean, over the next 10-15 years, I really think my assets are going to start paying for a lot of my bills. Honestly, that's what I'm planning on, and I'm going to keep building on that. And I'm not assuming that. There are assumptions in there to get to that. Yeah. But I'm going to continue to position myself well, and I'm going to have a joint account with someone who is better than me, and that's you. So the odds are in my favor, man.
Maybe I don't know. I just think that
yes, but there are a lot of assumptions, and this, look, I am not the gold standard of these things. I'm still learning, and I love to learn. I love to read. I love to educate myself through YouTube and podcasts. And I mean, in a year, I might have a completely different philosophy. I might have a completely different circumstance in my life. So this is just what I'm saying today, but. I mean, it's good. It's healthy to talk about. I mean, there are a lot of different views, and I mean, that's why we have this relationship, man. Because I tell you every day, you tell me when I'm wrong. You tell me
I'm not telling you you're wrong.
Not when I'm wrong, but you let me see the full picture.
You're not wrong. The thing is that you're not wrong, because you said that if my assets were enough, how much do you think you need to have invested to be like, okay, well, the amount that's being made off my investments right now, like starting now, would justify me having a mortgage payment with an interest rate, arguably maybe around like 5 to like 6%.
But adjustable.
Like per month / per year, the amount that's making from my assets is going to be more than the amount that I'm just giving to the bank.
So the starting point, there's so many variables, but in a perfect world, I would want to have all my debt gone and at least 200K in assets.
Okay, so that makes sense then, because if you consider $200,000 in investments And we'll give like a ballpark 10%.
Uh-huh.
Because let's be real, hopefully we can be able to make more than 10%.
Right.
If you're paying under $20,000 in interest every single year, then I can see it.
And look at the 70s. I don't know the exact, I don't know when like the statistics started on, like, I don't know if it was like 72 to 84, whatever, but technically the market was neutral. I mean, look at the people who invested at the top of the .com bubble. It took 15 years before they broke even on that. Right. So those things are not lost on me when I'm just throwing out.
But the housing market is different because the housing market has only been doing that.
Right. But I'm saying
like that justifies all of this. Where like maybe we should be getting into a home, but but like that's the thing though, is that rates are just so high.
But if you invest with a value investor mindset with a margin of safety, you wouldn't even be considering buying at the top because right now we know, like, that's another thing, we have to get in at the right time too, because we're not even really technically in equities right now. We're more in T-bills. We're just collecting our 4 to 5% right now. Right. So we're waiting for when that time comes, and that's going to be vital too. And we kind of talked about that earlier. But
so I think that I'm more on your plan than I was in the beginning, because I know that you want to be positioned. I thought that you were just trying to be like, okay, well, I'm doing this
tomorrow. Let's go.
Yeah. Or even within the next, well, I mean, you said the next 35 years. So let's say nothing changes.
Life happens.
Let's say nothing changes in the market, in the real estate market, or with anything going on in the economy within the next 35 years. Would you still wait?
Yeah, I at least want to have all my debt paid off, and I at least want to have at least $200K in assets.
Oh, okay. So that's a lot better than what I thought it was. So mathematically, it all checks out. You need to factor in everything because it's not just interest. I would say your assets need to outweigh PMI, interest.
Oh yeah.
HOA.
Absolutely.
And I'll take this one from freaking Dave Ramsey. You should have like a 3 to 6 month emergency fund.
Oh yeah, absolutely.
So yeah, you're fine then. I think that I was thinking that you were just gonna be jumping into this thing and just throwing money away. No. But that's not the case. He knows what he's doing. He knows what he's doing.
Hey, this is great. I love these conversations. So I mean, and this is a lot of good information for people to think about too. So
yeah, it is. Like
everybody's situation is different.
Really, the biggest takeaway is understand the kind of life that you want, because for all I know, you might not care about retirement or like assets, but you care only about your home.
Yeah, and
so you could pay everything into your house and be perfectly fine. It's whatever you want to do, because in the end, it's the option to be able to do it.
Yep.
I would argue right now, a lot of people don't have the option to do anything unless you're positioned well, and unless you're able to have the mindset to like avoid a lot of the pitfalls, like getting into like meaningless debt, buying cars you don't need. I don't know, not living below your means. Like if you do those things, then you can forget about like retirement and buying a home, because you might not be able to afford it.
That's a great point, because the common denominator in all this is you can go back and look at these rough periods. Even 1929 during the Great Depression, if you were positioned, you still made money, you still made it out. So it always is going to go back to your positioning. Right. That has to be your foundation. Right.
And that's what we've been telling y'all since the very beginning. You want to be able to position yourself not only financially, but like mentally.
Yes.
And disregard the noise and just figure out what you want. Do your research.
In the information age, if you're not taking your knowledge to a next level with all this stuff, that's a choice, because it is all right there.
Yeah, it is for sure.
And you put those things in 2 times speed, you can get I'm about to go for a walk after this. I'm gonna learn some more stuff. But I did want to say, and I'm gonna be real about this, guys. I've got over $50K in debt. It's a combination of student loans and one car that I'm paying off right now. So I got some work to do, guys. I should be working right now, man. I got to get to work now.
Hey, you're working here.
Absolutely. But that's the cool part. They get to see both sides of this. They get to see both journeys, and that's what Give and Grow is all about.
Yeah, because just to clarify, like I'm not as reserved, because numbers don't lie, but the numbers just have to fit within the structure of things. Having a paid off home is not bad early if that's what you really want. I'm like right in the middle of it all, because I want to have a paid off home as fast as I can. And I want to be able to have my assets grow as fast as they can. But I'm not trying to sacrifice one for the other, which is why, like, you know, I want to be able to have this nice middle ground between the two, because what I value over anything when it comes to like all this is like time.
Yes.
And to me, like the thought of still potentially paying off my home when I'm in my 60s is one of the scariest things ever. And there's a lot of people out there that are dealing with that. And there's a lot of people right now that can afford homes. I definitely think that it's going to be an interesting time period going forward. I would love a correction. I would love to be able to get into a house that I know that I can afford and that's not going to break my finances. But at the same time, you know, I'm content with where we're at right now. I mean, you know, I love this apartment. It's very, very small. It fits my needs right now. It's very, very cheap. And I love being able to throw a lot of money into investments, into T-bills every single month and see where that's going to take me. Because something that we also talked about, we view high interest rates not as a problem anymore, really.
Because we can take advantage of it.
Yeah, we can take advantage of it. You know, honestly, you know,
I don't mind if they go up higher.
I wouldn't care if they went higher. Inflation, I kind of care about going higher, but interest rates, not really, because either way, we can be able to make money regardless of what's happening. Because if interest rates go higher, you know, and if it puts pressure on like stocks, and stocks can like come down at a good price.
I mean, interest rates might be the only thing that can put pressure on the real estate and stock market.
No, that's true. So
we want better prices. We want better prices. We want a margin of safety. So
I will say the negative effects of interest rates, I feel a lot more for the people that are unemployed.
Yeah.
You know, once again, my heart goes out to everybody that cannot find work right now. It's a tough job market. Despite what the numbers say, I think that the average person would say that it's a tough job market. Even for people in my field, like, you know, like tech, I see a lot of people in tech right now that can't find work, you know, and just seeing like, you know, FANG companies, seeing, you know, all these other companies just like laying off a lot of tech workers. It's hard. Lowering interest rates would help people be able to get back into that, because companies can start hiring again. You know, it makes sense for them to hire when they can afford to pay their employees.
Yeah. I mean, as an investor, that's when you're looking your chops, man. That's when you can borrow. That's when you can do stuff. I mean,
right.
That's when you can get that house.
Yeah. And for the younger generation, take a look and see at what's going on right now, and you can plan according to that. Imagine being like 40 and you're over leveraged into a lot of bad debt, maybe even into like a house, and you lose your job.
Ugh.
And it's hard to find your job. Wouldn't you rather start right now and plan for your life to where you might be able to have assets? I mean, from 20 to 40, imagine grinding and compounding that money. You might not even need to work after that. You could be able to live probably, I mean, it might not be like crazy, but you might be able to have a form of a hedge in your assets to generate you some passive income. And a lot of those worries kind of like start to fade, but the earlier you start, the better, man. It's have the mindset that right now is the prime wealth building years of your life, and don't follow what the culture says. I know what the culture is going to tell you. Oh, you're in your 20s, live it up. But people in their 40s wish they can change things back when they were 20, and they're suffering for it. So
yes, future you is going to be thankful.
Yeah, exactly. But
think about 30-year-old Eric. Think about 40-year-old Eric. Think about 50-year-old Eric. That's the way you got to view it.
Yeah, and you know, you can start before you even turn 18 when you get the Roth IRA, by just changing how you view all of these things. And that's something that we definitely want to promote. So that's what I got for.
I love it.
For that.
I love it. That was poetic. Beautiful.
I just want to ask y'all if y'all can please subscribe to the channel, like the video. We hope y'all enjoyed our last conversation on debt in general. And thank you again for all of the support on my credit card video that I put out. Hopefully these things can be able to help you up your game and be able to make some good decisions based off of what you want. Because that's the only thing that I can really give y'all is a different approach. But really, I'm telling y'all, do your own research. Look into things that work for you. Don't listen to the culture when it says to go in a massive amounts of debt just to have things, and you'll be just fine.
Yeah, get nerdy about this stuff. Love it, live it, enjoy it, guys. Until next time, let's continue to give and grow.